Hello everyone and welcome back once again to our CA Foundation Business Economics series where we are trying to cover some of the important concepts in the chapter in a quick and practical manner. So without wasting much time, let's get back to our video. So today we will be continuing our last chapter, that is chapter 3, Theory of Production and Cost, in which we are today covering unit 2, that is Theory of Cost. So there are some concepts and along with that I have added some examples as usual. So cost concepts. Understanding cost concepts is essential for businesses to make informed financial decisions. So there are two costs. First, accounting cost and economic cost. So based on the study material I have as it is took the topics and I tried to add some practical example for it to help us or to help you to understand concepts better. So first, accounting cost. These are the actual out of pocket expenses a business incurs. They include payment for rent, salaries, material and utilities. Example, if a bakery spends rupees 5000 on floor and rupees 2000 on utility, the total accounting cost is rupees 7000. Second comes economic cost. These include both accounting cost and opportunity cost, the value of the next best alternative foregone. Example, if a bakery owner could have earned rupees 3000 working on the another job, the economic cost is rupees 10000, that is accounting cost of rupees 7000 plus 3000 towards opportunity foregone. Now comes outlay cost and opportunity cost. Outlay cost are the actual expense incurred in production similar to accounting cost. Example could be a restaurant's outlay cost includes spending rupees 10000 on groceries and rupees 4000 on rent. Then comes opportunity cost. As its name says, opportunity, the cost of forgiving the next best alternative when making decision. This opportunity cost is very important in practical life also. So the example could be, if the restaurant owner chooses to open a new branch instead of investing in a stock that could yield rupees 5000, then the opportunity cost would be rupees 5000. Then comes direct or traceable cost and indirect or non-traceable cost. Direct costs are the cost that can be directly attributed to a specific product or service. Example could be the cost of raw material used in manufacturing a car is a direct cost. Similarly, indirect costs are the costs that cannot be associated or traced to a specific product or service and are shared among multiple products. Example could be the salary of a factory manager overseeing several production lines is an example of indirect cost. Then comes incremental cost and sunk cost. Incremental cost are the additional cost incurred when a business decides to increase production or to add new product. Example could be, if producing 100 additional units cost rupees 2000, then this is an example of incremental cost. Second, sunk cost. Sunk cost are the costs that have already been incurred and cannot be recovered. Example, money spent on market research for a failed product launch is a sunk cost. Then comes historical cost and replacement cost. Historical cost, the original cost of an asset when it was purchased. Asset means simply you could say anything with add some value, could be land, furniture, plant and machinery, etc. Example, a machine bought for rupees 5000 5 years ago is recorded at its historical cost. Then comes replacement cost, the current cost to replace an asset. Example, if the same machinery which we have bought earlier for 5000, if we thought to buy it for now, it would be cost, it will cost rupees 6000. So This is called the replacement cost. Then comes private cost and social cost. Private costs are the cost incurred by a business or individual. A factory expenditure on labor and raw material is a private cost. Then comes social cost, the total cost to society including private cost and externalities. Could be pollution. Example, if the factory emits pollutants, the health impact of the community is a social cost. Then comes fixed and variable cost. Fixed cost that do not change with the level of output. Example, rent of rupees 10,000 remains constant whether a factory produces 1 unit or 1000 unit. And second comes variable cost that changes with the level of output. Example, the cost of raw material increases as the production volume increases. Then comes one of the interesting topic, that is cost function, which covers total, fixed and variable cost. The cost function shows the relationship between output and cost. First, total cost. It is the sum of fixed and variable cost. Example, if fixed cost is rupees 10,000 and variable cost are rupees 5,000, the total cost would be the total of both fixed plus variable, that is rupees 15,000. And I have defined what is fixed cost. It cost that remains constant regardless of output, and variable cost are cost that changes with the level of production, as I defined earlier. I have just added an example for it. Now we have output in units, that is 0, 10, 20, 30, 40. Then we have fixed cost. Fixed cost is, you can see that it is 10,000 and that is constant for all the output units. And there is one more column for variable cost, that is actually in first case, since there is no output, it is 0, and from second onwards it is increasing based on the output, that is 2,000, 4,000, 6,000, 8,000. And total cost is nothing but the total of fixed plus variable, that is 10,000, 12,000, 14, 16, 18 and so on. Now I have tried to create a graph for a better visual presentation, which is as above. So this is cost analysis. This is our variable cost that is increasing. This is fixed cost that is constant throughout the output, and the gray line is the total cost that is also in the increasing direction. Now comes short run average cost, that is average fixed cost. We have calculation for it, short run average cost. So first one is average fixed cost, that is fixed cost per unit of output. We can compute it as average fixed cost equals to fixed cost divided by output. Example, if fixed cost are rupees 10,000 and output is 20 units, our average fixed cost is equals to 10,000 divided by 20, that is nothing but rupees 500. Similarly, average variable cost are variable cost divided by output, which are in our case would be rupees 4,000 divided by 20, which will be equal to rupees 200. And then comes average total cost, which will be nothing, just a minute, there is some typo error here. It will be total cost divided by output, which will be in our case we can 500 plus 200, that is 700. And then comes marginal cost, that will be the additional cost of producing one more unit. Marginal cost is difference in total cost divided by difference in total output. Example, if producing an additional unit increases total cost from rupees 14,000 to 14,500, then the difference rupees 500 will be our marginal cost. Now we have a tabular presentation where we will be discussing relationship between average cost and marginal cost. Average cost is total cost divided by total units, and marginal is the additional cost. So I will try to explain just 3 pointers or 3 conditions. First, when marginal cost is less than average total cost decreases, so it will be in a decreasing direction. Similarly, when marginal cost is greater than average total cost will rise or increase, and marginal cost intersects average total cost at its minimum point. So this is our one more example where we have output from 0 to 10, 20, 30, 40, 50, 60. There is fixed cost, that is 10,000, which is constant. Then we have variable cost, that is 0, 2,000, 3,500, 5,000, 6,800, 9,000, 11,500. So there is an increasing trend. And then comes total cost, which is nothing but the total of fixed plus variable, that is 10,000, 12,000, 13,500, 15,000, 16,800, 19,000 and 21,500. Then comes our average total cost, which will be in first case, since the denominator is 0, we have not calculated here. In second case it will be 12,000 divided by 10, that is 1200. Similarly in third case 675, 500, 420, 380 and 353. Similarly we will calculating marginal cost. It is nothing but the difference in the total cost divided by difference in the output. So in our first case it would be 12,000 minus 10,000 divided by 10 minus 2, that is increase in output. So in first case it will be 200. In second case it would be 13,500 minus 12,000 divided by 10, it will be 150. In third case also it will be 150. In fourth case it is 180. In fifth case it is 220, and lastly it is 250. Now we will be trying to analyze the data. So when marginal cost is less than average total cost decreases, that is from 0 to unit 30. You can see average total cost is decreasing because marginal cost is less than average total cost. So our average total cost is 1200, marginal cost is 200. Similarly average total cost is 675, marginal cost is 150. So this is more than marginal cost, so we can see it is increasing. And we have one more example for when moving from 10 units to 20 units, our marginal cost is rupees 150, which is less than the average total cost of 1200, causing ATC to fall to 675. So this is from 0 to 30. Then comes second part. Marginal cost intersects ATC at its minimum point, that is at 30 units. So at 30 units, here ATC is the minimum of 500 and the MC or marginal cost is 150. At this point MC equals ATC, and this is the point of productive efficiency. So this is the efficient point of production, that is at 30 units we will be having average total cost of 500 and marginal cost of 150. Then comes the third point or third condition. When marginal cost is greater than average total cost will increase. Earlier it was in a decreasing trend, so you can see there will be fall, then it will slowly rise again. So from 40 to 60 units, as the output increases beyond 30 units, marginal cost becomes greater than average total cost. For example, moving from 40 units to 50 units, marginal cost is 220, which is higher than the average total cost of 420, causing average total cost to rise to 380. Just a minute, 220, 420, 220 rise, yes. I think there is some typo error again. Now comes interpretation, why it's happening. First, at low output levels, fixed costs dominate, making average total cost high. However, as output increases, variable cost spread out the fixed cost, reducing average total cost. Then comes point of minimum average total cost, that is the optimal point of production, is where average total cost is minimized. This occurs when marginal cost intersects average total cost. So I will try to add a graph for it, so you can help. I will correct the notes and try to add a graph which will help you to understand the concept more better. And third comes at higher output level, variable cost increases faster than the reduction in fixed cost per unit, leading to an increase in average total cost. So long run average. Now comes one more topic, long run average cost curve. In the long run, firm can adjust all inputs, and the long run average cost, that is LRAC curve, shows the lowest cost of producing each level of unit. So again, due to some time constraint, I was unable to add the graph. I will correct it and try to share with you in the future video. Then comes economies and diseconomies of scale. It is the part of the scale of production. Economies of scale. Economies of scale, it refers to the cost advantage that a business can achieve by increasing its scale of production. As the company grows, it can spread its fixed cost over more units of output, leading to a lower average cost per unit. Then comes diseconomies of scale. It occurs when a company grows beyond a certain point and experience increases per unit cost. So the cost will be increasing instead of decreasing. So there are some factors for both economies and diseconomies. We will be discussing that. First, internal economies and diseconomies. In that, technical economies, achieving through efficient production technique. Example, using automated machinery reduces production time and cost. Then come managerial economics, that is specialized management leads to better decision making. Example, hiring skill manager improves efficiency and productivity. Then comes commercial economies, that is bulk purchasing reduces input cost. Example, buying raw material in larger quantity at discounted price. Then comes financial economies, that is larger firm have easier access to credit. Example, established firm secures loan at lower interest rate. Then comes risk bearing economies, that is diversification spreads risk. Example, a company producing multiple products is less affected by the failure of one product. So we have diverse products which will help to reduce the risk. Then comes external economies and diseconomies. What could be external factor? First, cheaper raw material and capital equipment, cost advantage due to a developed supplier network. Second, technical external economies, that is innovations reduce cost. Example, new software will improve overall production efficiency. Third comes development of skilled labor, that is training programs enhances workforce quality. Then comes growth of ancillary industries, so the support industries improves supply chain efficiencies. One more could be better transportation and marketing facilities. Infrastructure improvement will help to reduce cost. And lastly, economies of information, that is access to market data aids decision making. Example, data analytics helps optimizing pricing strategies. Now comes to end of the chapter where we have MG extras, just like in the previous video, where we have some practical activity or concept which will help you to understand the topic better. So in our today's MG extras, we have choose a local business such as cafe or bookstore and interview the owner about their cost structure. Focus on understanding their fixed, variable and opportunity cost as well as the economies or diseconomies of scale they experience. So coming to a conclusion, understanding these cost concepts is vital for making strategic decisions. By balancing economies and diseconomies of scale, we can optimize our production process and stay competitive in the market. Thank you. Keep learning, keep going, growing and keep enjoying. Bye bye.